If you take a big step back to the day before the lockdowns started, we had a normal functioning economy that was growing by, call it, 2% a year. And the minute that we enforced these lockdowns, I actually think what we did was we started a supply side recession.
Hey guys, welcome back to Library of Wealth. Today we have Chamath giving us his prediction for the current market. Chamath has been pretty accurate, even predicting back in January the current crash and recessionary climate we're seeing now. We'll take a look at that prediction along with his investment thesis, and we'll see how that's going to affect the stock, crypto, and capital markets over the next few months. In this interview, Chamath tells us why he believes we haven't seen the worst of it, and with the increase in interest rates, we'll see a recessionary correction happen in stock and capital markets up until the end of the year. Make sure to stay till the end of the video to hear what Chamath's prediction for the current market crash, inflation, and how this recession will affect the financial markets and what's coming next.
If you take a big step back to the day before the lockdowns started, we had a normal functioning economy that was growing by, call it, 2% a year. And the minute that we enforced these lockdowns, I actually think what we did was we started a supply side recession. It's what Zach said earlier. So what does that mean? Let's just say you're a factory and you make wheels. Okay, just make something really simple. You were growing at 2% a year. Everything seemed hunky-dory. You had employees. It was fine. You used to sell your products, make 10-15% profits. Everything was fine. And then the day after, the government said, you need to shut your factory down because we can't have people spending too much time close together because we need to get a handle on this pandemic. Okay, so you shut it down. And then for the next 12 or 18 months, what happens? That stuff sits idle. These people that used to work for you get $2.5 trillion put into their bank accounts. They spend their time doing other things. And then all of a sudden people say, okay, it's time to start the factory up again. People want to buy wheels. And now all of a sudden you find that because everything all around the world was shut down, there's no rubber to make the wheels. There's no steel to make the axle. There's no people to put them all together. And so what happens? Well, prices go up because, again, you gave everybody else $2.5 trillion. So they're like, well, I used to pay $1 for your wheel. I'm willing to pay you $2 now. Just make the wheel. Give it to me before you give it to somebody else. So that is like the classic definition of a supply side recession. And now by raising rates to some crazy amount, the end of which we're still not sure about, may actually then trigger the demand destruction to have a demand side recession. And so I don't know that we've lived in a modern point in time where both things have been true, right? There's been a principle of macroeconomics that everybody's always kind of debating, is this a supply side issue? Is it a demand side issue? We know that in COVID, it was a supply side issue. We took all the supply out of the market. And now we're trying to figure out when we exhaust, all of the money we've given people, and we destroy demand and take the incentives for demand to go away, right? Consumer confidence is now starting to turn. What happens then? Well, we're going to figure that out in the next 6 or 9 months. But the thing is, you have both that are true. It's not as if the supply side of the economy has been fixed. It's not as if everybody is running at 100% capacity. It's not as if all the supply chain issues have been worked out.
Yep.
So I don't know. I just think it's a very complicated situation.
Chamath goes on to discuss the effects of 401ks being wiped out, the stock market being down, and the effects inflation is having on wages. And those are just some of the reasons the sentiment is so negative in the market right now.
I mean, look, there's an old saying that a recession is when your neighbor loses his job and a depression is when you lose your job. And the reality is we haven't had the big job losses yet. It's starting. We can start to see it in the number of open recs are getting closed. And then there were those job loss numbers that just came out, which were a little higher than expected. So the job losses are starting, but so far it's really been the step prior to that, which is people are seeing their 401ks get destroyed, stock market's down. They're seeing their wages get destroyed by inflation, food and gas prices being much higher. So there's a really good reason why sentiment is so negative out there. People feel poorer than they were before. And this could get worse, like you're saying, Jason, with their nest egg in their homes getting hit. I agree. That's the next shoe to drop, just like the commercial real estate is the next shoe to drop. But I think the really big question over the next 6 months is what sort of job losses do we see? Because that really is going to be the big determinant of of how hard this recession hits.
It seems to me like this is sort of akin to what Sachs was relaying about that founder at the Co2 conference, which is like, he thinks everybody else is going to, roll up their sleeves and buckle down, but he has no intention of doing it. I think people are roughly the same way. And I think their behavior is, well, if things are going to get hard, I'll deal with it in the future. But right now I have money in my pocket. And, if you look at airlines and how many people are trying to travel, if you just look at like the cost of a hotel room, if you look at what's happening this summer, it does not seem like people are slowing down or tapping the brakes in any way. I just think after 2 years of a lockdown, I do think that people are anxious to reestablish some amount of normalcy. And this is really the first summer where everybody writ large can be out and do the things that they were planning on doing.
Last year was the head fake summer, yeah.
Last year was a little bit of a head fake. And look, you have 2 years of pent up plans of,
Weddings.
50th anniversaries and weddings and all of this stuff that's happening. Yeah. And so I think people are really spending money.
And if you look at it, the consumer is holding up amazingly. It's got to be some combination of jobs, home prices, and this inflation.
But this is why there has not been a downtick in demand. I don't know why everybody thinks that there's been a downtick in demand.
It hasn't.
There was an article today.
Up in the numbers yet. It's not showing up in the numbers yet.
No, I think it is.
Then it's just anecdotal and guessing.
It's very subtle. Okay, sure. It is. There is a subtle.
I actually disagree with you guys. I actually think that the economy is pivoting on a dime here, and it's starting to show up subtly in the numbers. Here's some other data points. Consumer sentiment. Biggest drop in consumer sentiment in 40 years. That was in the last month. Right track, wrong track polling. Only 10% of the country thinks we're on the right track. If you poll people and ask, are we in a recession? Something like close to 60% of the country already thinks we're in a recession. There's a slight political tint to that. More Republicans than Democrats think we're in a recession. However, even roughly half of Democrats think we're in a recession. So I think
those are all feelings, not behavior, though, Sachs. We're looking at the data, not the sentiment.
I think the behavior will catch up with the sentiment. I think the behavior is pivoting.
Yeah.
It's just that I think you have to dig beneath the surface and you have to look at things like retail sales, things like that.
I'm not sure, David, if you look back on all the number of times consumer sentiment has dipped, that the correlation to spending patterns is so uniformly predictive as we think. I mean, I think that there's a slight positive correlation, I remember, but I don't think it's like, 0.75, 0.81. It's not that. So there's this weird preference falsification that happens when you get asked, what do you think is going to happen versus then what do you do? Yeah. And I think a lot of consumers, that's why they have, we know the data in America, like less than a month of savings or whatever those numbers are. Despite all of the sentiment analysis and all of this stuff, you would think that there'd be behavior change, but mostly people kind of just live in the moment. And, that's partly because they don't have the structural support to save or other things. But the reality is that most folks, from what they say to what they behave, there is a gap. I tend to agree with you. Like, I think that we have been in a supply side recession. That is what has caused inflation. We have to go through a process of taking all the excess money that's been put in out. And when you do that, we will destroy demand. And then that'll trigger a demand side recession because people will
destroy asset values.
And we will destroy asset values. So
we started that process. Asset values went real quick. Yeah.
That will happen second. And I hate to be the bearer of bad news, but the reason why I think that we're still in the first part of this process is because people, broadly speaking, still have a lot of savings because of all the stimulus checks. There is still a lot of money. So how will we know, maybe is the better point, when all of that excess savings has been, torn away from these people because of high prices? I suspect it's when Jason's first chart starts to close, right? So when people are, they're more motivated to re-enter the workforce. I think that's a signal. Freeberg, your signal is another one, which is when credit delinquencies really start to spike. It's because people then, tapped out their savings, then they tap their credit cards, and then all of a sudden they become delinquent. When all of those things happen, you're probably now at a point where that first phase of the supply side issues are largely done, and now you get to the demand destruction. But all of those roads, unfortunately, lead to the same conclusion, which is like, equities get really under pressure. There is no scenario where there's a bid to equities. Why would you buy something that has lower earnings in the future? Or why would you buy something that has a lower discount rate for profits in the future? In this case, both are true.
The Federal Reserve is focused on keeping inflation under control, which is making investors nervous as the US economy gives conflicting signals about growth in the market. While you might expect more discussion about the Fed holding off on raising interest rates, all indications are that the Fed will be less reactive to markets than in the recent past. What do you think about Chamath's take on the current market? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.